everyone, Keshav Kalor here, principal and co-founder of clivecapital. I'm joined here by my fellow principal and co-founder, John Lai,
Hi, everyone.
and our partners, Courtney and Alexis, over at Aleo Energy. Aleo, yes?
Yep, you got it. Aleo is actually oil in Greek, and so
Okay.
honored to be here.
Yeah. So this webinar, we're going to target 45 minutes. People love this stuff, so they're going to have a lot of questions. They've never seen anything like it, and that's why we're bringing it to you folks. So tune in, throw any questions you have in the Q&A. We'll get to them as we go along. We'll save some time at the end. And this will also be uploaded and recorded and uploaded and sent back out to y'all over email. Without further ado, we're very excited. I've been bugging Courtney about this for Lord knows how long, 4 to 6 months, but finally it's here, Iron Horse Energy Fund 1. So general disclaimer, we're not financial advisors, legal advisors, tax advisors, any such advisors. This is purely for educational purposes. We're not making any promises. There's risks with investing, all the good stuff. Read this on your own time here, but do consult the professionals in your life before you make any decisions. And these are all just projections. We're not genies. We don't know what the future is going to hold. So an executive summary, clivecapital is pleased to present our third oil and gas opportunity and our largest one, the Iron Horse Energy Fund 1, a $100 million diversified oil and gas fund designed to deliver monthly cash flow and substantial tax benefits for accredited investors. The fund will be focusing on acquiring non-operating working interests to provide investors with direct ownership of production revenue, along with full access of powerful tax benefits in U.S. energy, while limiting operational risk by partnering with the cream of the crop, the best drilling companies and the best partners in Aleo. So this fund is going to provide a powerful combination of monthly passive income, 80 to 90% year one only. It's not every year, it'd be too good to be true. Just year one tax deductions to reduce any type of taxable income, whether that's W-2, capital gains, passive income, active income, you name it. Diversification across multiple operators, also known as like drilling companies, the basins that we're investing in, and multiple wells. And it's inflation resistant and a commodity-backed investment with cash flow. So now is the time to invest in oil and gas. We're currently operating at around a 5 million barrel per day deficit. And long-term demand for energy continues to grow, and we just aren't producing enough. And smart money, as we'll see in a couple of slides, is going very heavy into oil and gas because of the lack of investment or underinvestment for the last couple of years. There was a lot of focus on green energy, and so that really demonized fossil fuel production, and now we have to play catch up, which is a good place for us to be in as investors. Unparalleled tax advantages. I'll be saying tax advantages probably 30 times in this webinar, so just get used to it. And long-term monthly passive income. The potential and the tax benefits specifically, the potential to offset any type of income with IDC's intangible drilling costs and a 15% depletion allowance. So we're looking at two different types of tax benefits here, which we'll go into more. So a lot of people always like to ask, Courtney and myself, are we going to ever go green? And we are both on the same page that that's not going to happen for a couple of decades at least. Here, you'll see that 80+% of our energy still comes from fossil fuels in oil, coal, and natural gas. Not only that, but 6,000 daily products that you use, you might not have thought about it, but they come from oil and gas byproducts. This includes pharmaceuticals, medicine. This includes plastics, includes makeup, clothing, you name it. Oil and gas is probably in it, including a lot of the components that you need to go green. Wind turbines, solar panels, your Tesla cars, oil and gas has a role to play in each and every one of these. So even that transition to EVs and green energy is going to require a lot of oil and gas. So when we said smart money is flowing into oil and gas, here's who we mean. Warren Buffett, of the Oracle of Omaha, Berkshire Hathaway, has invested more than $28 billion into Occidental Petroleum since 2022, representing a 28% equity stake in the company with rights and regulatory approval to buy up to 50%. Why? Because he sees where the future is going and that we're not getting off of fossil fuels anytime soon. And I don't know about you, but I like to take Mr. Buffett's investment advice. Second, the UAE and Abu Dhabi National Oil Company. So this is an OPEC nation. They're producing oil themselves. They're still choosing to launch a $5 billion fund in 2023, a few years ago, to invest into US upstream oil and gas. Other big names, especially in private equity, include Blackstone, Energy Partners, KKR, Apollo. All of these big folks, big firms are investing into oil and gas. And that's what we love to see when we're looking at new asset classes, especially oil and gas, is who is investing in it. And that helps us further strengthen our investment thesis. And the Canadian pension fund, sovereign wealth funds like Norway's sovereign wealth fund as well. The tax benefits, what everyone is probably here for, especially given a record year in the stock market with all the AI gains that we're seeing. And a lot of you in the audience are probably from the tech industry, given, my background at Meta and Amazon, John's background at Amazon and Apple. You're going to pay pretty high taxes this year because you're being paid, with RSUs and stocks. Those have done pretty well this year. I know I have a big tax bill coming up, and this is going to be a part of my strategy. So the potential here to offset any income is very unique and rare, and was one of the favorite things we love about oil and gas. The reason we're able to claim a lot of these deductions, it can be broken into two parts. Intangible drilling costs, IDCs. These are non-recoverable expenses that have to go into drilling, like fuel, labor, permitting, surveying, insurance, chemicals, things like that. They're one time, they're used up. You cannot resell them or recapture any of its value. And that actually makes up 60 to 80% of the well cost and 60 to 80% of our deductions that we claim. And these are 100% tax deductible in the year they occurred. So in year one, in our case, in 2025. Tangible drilling cost deduction, TDC, this refers to the cost of any asset you could sell in the future. This includes drilling equipment, pump jacks, casings, wellheads. They are 100% tax deductible. They're capitalized and they're depreciated over a 7-year period. A big question we get from investors, a lot of folks who come from the real estate world, is what is the risk of recapture? And so my understanding here, Courtney, feel free to jump in, is that with intangible drilling costs, because they're non-recoverable, non-recapturable, they're not subject to the risk of recapture. Whereas with tangible drilling costs, depending on when you sell, you could be subject to depreciation
Yeah,
recapture.
well, and we typically don't sell these types of assets. With this fund, we are looking to exit somewhere in that, seven-ish year time frame. At that point, we will have depleted, 85% of the oil in these wells. And so when we sell, we always just want to make sure that we sell at or below our cost basis. And that way we will not have to worry about recapture. Coming into these deals, the tax benefits really matter. And our investors are coming in, a lot of them, obviously we all want to make money, but the tax benefits are a really big piece. And we don't want any kind of surprises at the end unless we have some huge major oil discovery underneath our mineral rights where we've got, some major upside that's going to potentially outweigh any potential recapture that we might face. So,
Yeah, specifically, if there were like 20 different wells, new wells that were going to be drilled, then it would make sense there to sell, even takes the tax hit as long as the profits make sense to do so. And lastly, the depletion allowance, another great tax benefit of oil and gas. The first 15% of all gross income and production revenue is excluded from being taxed. That's for the lifetime of the investment, and the returns that the investment produces is treated as ordinary income. I'm trying to think. So I would say the one big thing here is you probably hear a lot of people, a lot of your CPAs probably don't know about oil and gas. If you need a recommendation, we're happy to provide one with someone who knows how to handle oil and gas. And two, I think, I don't know, maybe Courtney and John and Alexis could correct me, but anyone who tells you to invest in Airbnbs for tax benefits doesn't know about oil and gas because I feel like oil and gas is just that much better. So next, our strategy. So our strategy is to partner with major operators, public and private. Most investors don't get the opportunity to do this because these companies that we're drilling with are big companies, publicly traded companies like EOG Resources, for example, as well as some very large private drilling companies as well. They don't need our money to drill. They have plenty on their own balance sheet to go out and drill. We go in once we get wind of a major drilling company going out to drill. We go in and kind of weasel our way in, for lack of a better word, to acquire an equity stake ourselves. And that is a lot of times what you won't get access to. A lot of times you'll have people who need to raise capital that are looking to you to invest. Here, these companies don't need our capital, but we want to get in with them anyway. And these are some of the companies. Slawson, we closed on a deal with them a month or two ago in North Dakota, 8 wells. Anschutz was the first company that I invested with Courtney almost 2 years ago now. And we did another deal with them back in December. Continental, we did a deal with them back in December. And the first 8 wells in this $100 million fund is going to be with Fulcrum Energy Capital. So these are just some of the big names that we like to work with. In addition to that, we only will go into top producing areas in the Permian, which is West Texas, the Eagle Ford, which is South Texas, I believe, the Anadarko, which is North Texas and Oklahoma, the Niobrara, which is Wyoming, Colorado, and Nebraska, and then the Bakken, which is North Dakota. So even though you might hear people investing into Louisiana, we won't go into Louisiana because it's a lot more predictable. Same thing for Pennsylvania and New York. Even though this is where oil was actually first discovered, we won't typically invest in these areas. And for diversification, one big question we always get is what happens if a well is dry? We'll go into that in a bit, but one great way to mitigate that is by just investing into multiple wells to mitigate that. So with this $100 million fund, we're going to be acquiring between 50 to 100 wells to diversify our investors across multiple drilling companies, multiple basins, and multiple wells. So key risks and mitigation. Let me just make sure that I'm okay. Okay. This seems a little out of order, but we'll go with it anyway. Maybe it's something on my end. So key risks and mitigation, all of that sounds great, right? 80 to 90% tax deduction in year one and monthly passive income. Obviously, there are gotchas. There's no investment that's risk-free except putting cash under your bed, and even that comes with its own risks. So the number one risk is uncertain returns. I tell my investors, a lot of folks who are from tech, who are engineers and like to quantify everything just like I do, it's like trying to quantify where Meta stock is going to be over the next 5 years. No one knows, no one has the glass crystal ball. Some of the ways we mitigate that is by diversifying across multiple wells, across multiple companies, and multiple basins. Number two is the price volatility, right? Oil, when I invested 2 years ago, was about $80 a barrel. Now it's closer to 60, $65 a barrel. At the height of the Ukraine-Russia war, it went as high as $120 a barrel. It's all over the place. So to mitigate that, we target wells with $35 to $40 barrel, like per barrel, break-even price, meaning oil would have to drop below $40 a barrel, which is, would have to drop an extra 33% from where it is now. And then we're at risk of being at a loss. We don't see that happening, but we will mitigate that risk in a few line items. But that's one way we mitigate price volatility. And second is, again, diversifying across multiple wells. And third is underwriting with conservative oil prices. On this opportunity, which I should be coming up in a few slides, we underwrote this project at $72 a barrel to be conservative because over the last 5 years, including COVID, when oil dropped sub-zero, I believe, it still averaged $72 a barrel. Now, one, hope, knock on wood, that shouldn't happen again, such a black swan event that destroys demand. And two, oil benefits from inflation because it's a commodity. So even though it was $72 on average over the last 5 years, we've seen a lot of inflation. We're going to continue to see more inflation, so we should actually benefit from that by investing into a commodity like oil and gas. No assurance of commercial production are basically the risk of either hitting a dry well or you drill, but you realize that you can't get to the well because of the rock formations under the earth. It's not commercially viable to do so. To mitigate that, we invest with top tier operators who have done typically 1,000+ wells. Our partners here, like Courtney and Alexis, and one of our other partner companies, DW, over the last 18 years, has invested in over 1,100 wells. And only 6 of them failed to produce commercially. And I believe there was another 4, Courtney, if you want to share some light on that.
Yeah, I think there was like 10 total out of, more than 1,100 that either were dry or they just couldn't commercially produce it. They might have hit oil in those wells, but they just couldn't actually extract it from the ground. And so one thing that, obviously we can't pack everything onto these slides, but, we're drilling horizontal wells. You've got vertical wells and horizontal, and the success rate of horizontal wells is 90% plus. And so, we haven't had, since I've jumped in and started doing this, we haven't had any dry wells, knock on wood. But let's say we do have one that can't produce. That's why we want to have capital allocated across as many wells as possible so that, a lot of people, when I find out that they've lost money, it's they invested in a project that only had one well. So we don't want to do that. And because of our horizontal drilling, appetite, along with the types of companies that we're, operating with, our success rate's very high.
So that's a 99% hit rate, 1% failure. I would take those odds any day. And then the other thing is we also either always or almost always, feel free to correct me if I'm wrong, wait to acquire an interest into a well or the land until drilling has begun to mitigate that risk. Delays in drilling and operations. So as I mentioned, we only acquire a 3 to 10% equity stake in each well. I don't know if I mentioned that, but that's kind of our range is 3 to 10%. We're minority equity holders, so we can't be bossing the drilling companies around about when to drill. They are the majority shareholders. They decide when to drill. So there are some potential delays in when drilling starts, but again, that is mitigated by us waiting until drilling actually starts. And the other thing is sometimes it can be beneficial. Investors can actually benefit from waiting for stronger oil prices. And if delays do occur, that's why we're invested across multiple companies, multiple wells. Even if one company decides to delay in one set of wells, we'll have a bunch of other companies and other wells producing. Lastly, monthly lease operating expenses, LOEs, exceeding income. That's basically saying, hey, our expenses are higher than our revenues, the revenues that the oil and gas is bringing in. This happens if the price of oil falls below the break-even price and stays there consistently long enough. The 2 ways we mitigate that is one, getting a really low break-even price at $35 to $40 a barrel by acquiring at the right price and investing with the right large-scale companies to benefit from economies of scale. And to be extra safe, we have a 5% contingency fund to cover these potential costs. We might put it in an interest-bearing account, whatever it is, so that it's not just sitting there. But that 5% contingency fund, roughly $5 million, will help us weather some of those storms. So metrics that matter, it's a lot of business, a lot of investing is not how, it's who. And so the folks that we're working with, Courtney, Alexis, and DW, in the next slide, we should be going to their experience, collectively have invested in over more than 1,100 wells. And only 6, maybe 10 were dry. That's still a 99% hit rate. That's across 175 deals over the last 18 years, since 2007 or 2008, across 700 plus, 1,000 plus wells, I believe. 150 million barrels of oil, 750 billion cubic feet of natural gas, and more than 1,000 investors. Okay, team. Courtney and Alexis, if you could both come on, introduce yourselves.
Yeah. So, I find a lot of people will move into asset classes that maybe they don't specialize in. And for those of you that don't know me, I am originally from the Permian Basin. My entire family has been involved in oil and gas my whole life. And so we have lived in Abu Dhabi, we've lived in Pakistan, and then even 20 years before my dad retired, he was drilling in Jakarta. And so I inherited his oil and gas company back in 2011 when he passed away, and we've continued to drill with companies like ConocoPhillips and SM Energy throughout the Permian Basin. And so this really is something that, I've got a pretty extensive background in. My entire family still in the Permian Basin. They've got well servicing companies. My sister actually drives a water pipe truck out to these wells, and my brother was drilling, but unfortunately, he is no longer with us, and so otherwise he definitely would be. So this is definitely something and an asset class that I have a ton of experience in. I love it, and I spent a very long time. Like Keshav said earlier, these companies aren't looking for private capital. These are billion and multi-billion dollar companies. Continental Resources is the number one private oil and gas company in the United States, and being able to drill alongside Harold Hamm is incredible. And so I had to figure out, how, if we're going to drill, that's who we want to drill with. They've got lower break-even numbers, the economies of scale, and we figured that out, and it's been really great. I think we've done a great job of risk mitigation and everything else, but I'm excited to be here. I'm really excited and honored to partner with these guys again, and I'm always here for any questions or anything that may come up. This asset class is my specialty. And Alexis, her camera keeps kind of going off and on.
I know, I'm sorry. I keep going back and forth. I'm Alexis. I'm actually investor relations, just kind of in the background, just doing anything, Courtney, Keshav, John, may need, and I'm here if anyone needs anything.
Okay. Rick isn't here with us today on this call, but
Yeah,
Courtney
and I
probably.
can give a quick little background of Rick. Rick is a landman. And so if any of you have seen the show Landman, Billy Bob Thornton and what he does, I don't know that I would necessarily call that a landman, but what his son does in the show, where he is out, looking for opportunities and wells with landowners and things like that, that's really what, landmen do. And so, Rick and I discovered that we were both in the Navy at the same time, and he got back to school to TCU and got his land degree or whatever that was back, I think in 2007 or 2008. And so his family also has an oil and gas background. And so I was really honored to work with him. I found him through some other people and went and said, "Hey, will you please come work with me? Let's give this a shot." And it's been good. And now we're kind of growing and scaling that out. And so one of my favorite things about him is he is a straight shooter. I have found that in the oil and gas space, you can get some characters and things like that. And he is very honest, very straight shooter, and I really appreciated that. And I snatched him up very quickly. But his experience is, second to none. And we've got a really, really fantastic group of landmen, kind of boots on the ground that are out, hunting these deals down for us. So he's exceptional.
My background, currently working at Meta for the last 4 years. I used to work at Amazon, run the real estate club at Meta, and used to run at Amazon as well. So far, I've helped our investors, primarily tech investors, invest into this portfolio. Specifically to oil and gas, I was looking for oil and gas investments probably 3 years ago and just didn't know who to trust. As Courtney said, this industry is full of characters, people who will scam you, who are fraudulent. I almost went in with one, but luckily I avoided it. Met Courtney at the right time. Maybe it was fate, whatever you call it, through one of our networks that we're in and a mutual connection. Made my first investment with her 2 years ago now into 8 wells in Wyoming. Got the tax write-off against my W-2, made a 40% return in 2024. Knew I had to bring this to my investors, so we brought our investors in for a deal for 8 wells in Colorado last December, and then we just closed on another 8 wells in North Dakota, uh, 2 months ago, probably. And now we have running it back for the third time. Third time's a charm. So
And a little bit about my background. Very much like Keshav, I've been working in high tech for the longest time. Prior to that, consulting, some finance in there. And as all of us W-2 earners, we're always looking to shield our tax and taxable income. And so the W-2s, historically, we've always been invested in 401ks and IRAs, but looking for that tax shelter. Oil and gas is one of those assets that can meet all the buckets, check all the check boxes, right? It has the tax deductions, it has the passive income, which is great. So I'm glad I got into oil and gas, entered into my first investment with Courtney about a year ago. And so definitely saw that. Believe it was like 84, 85% tax deduction on my returns, which is fantastic. So I'm looking forward to investing more in oil and gas.
Okay.
And while you're doing that, I'll talk a little bit about why we even built this fund to begin with. I was so excited to be able to participate alongside companies like Continental and EOG and Anschutz, but it was tricky. I mean, a lot of the smaller operators, and we've seen that in 2025, a lot of them have had to go offline because they're just not profitable at, below $65 oil. And so it's exciting because many people will never get to drill with these guys, but if you're going to drill, this is who you want to drill with. They have the best technology, the best equipment. And, even when I started participating with these guys several years ago, I thought I had things figured out by making sure we had a minimum number of wells or, hey, we're in these top proven basins, but you can still have wells that come online that maybe don't produce as much as you think they're going to. You can still have delays. One of our projects, we had a title issue and it took a little bit to get that fixed. Now, I mean, obviously our first check had all of the back pay from it, but it has delays. And so I thought, okay, what's the next step? How do we do this better? And actually, the last deal that I did with John and Keshav, we had two different operators in three different locations up in the Bakken, and that has been fantastic. We just closed that a couple of months ago. We've got some of those wells are already online and paying out. The next set is going to happen any day now. We'll start getting paid from them. And so, if we do experience delays or anything, we've got, 50 other wells or 80 other wells that are not impacting that. We're not feeling the impact from just one small delay or one. I don't think we're going to have any dry wells. I think the likelihood of that is pretty close to none. That's always a big question we get, but this fund is really a culmination and a product of, okay, what did we learn through these other deals? And I'm very excited about it. It's a fantastic asset class, but we want to make sure that we build something that's strong and can withstand, downturns in the market. Because like Keshav said, I wish I could predict, oil prices every month for the next 5 years, but I can't. There's no way to do that. So what we've done is build a really strong product that can withstand, if we can be strong and still have payouts when we're sitting at $60, $50, $45 oil, gosh, when we go back to that upside, it's really nice and everybody gets really excited about that. So I'm really proud of what we've built. I'm really excited for you to be able to come and join it because I do absolutely believe that this is probably one of the very best ways that you can participate in working interests in oil and gas.
Thank you, Courtney. I appreciate you covering and all valuable information too. So the fund terms here, this is a 506C deal for accredited investors only. Minimum investments, $100,000. Our hold period is roughly 5 to 7 years. As we mentioned earlier, if it makes sense to exit earlier, we will. If it makes sense to exit later, we will. At the end of the day, it's about maximizing profit while taking into account what our tax bill would look like. First year estimated K1 loss is 80 to 90% of your investment. So every $100,000 invested, you'll be able to claim a deduction of $80 to $90,000, again, offsetting any type of income that you have, W-2, capital gains, active, passive, you name it. A target return, we're roughly targeting a 2 to 3.5x to be conservative. It is a really wide range, and that's because the volatility of just oil pricing and how it works, we don't know that we can comfortably get any more, honed in than that. Courtney,
Yeah, I feel really good. I mean, I feel good about a 2x. Now, if we have stronger oil prices, which I think we will move into, we'll have higher returns. But this was underwritten very conservatively at lower oil prices, and not just lower oil prices, but lower production on these wells. So I feel very good about these numbers. And we have a little bit of a range in that 80 to 90% of that K1 loss because we haven't acquired all of the assets yet. The first 8 Colorado wells that we've bought, I think we're getting somewhere around 92% of a K1 loss for that deal. But, there might be some other ones that we pick up that come in at 82 or, a lower number. So we'll fall into that range. I just don't know what it's going to be just yet. And the two to 3.5x does not include the tax losses. That's just pure return. I don't like to add tax losses into those numbers.
And the offering period, we're closing November 30th, so we have roughly 2 months here. We did a capital raise during December of last year. Don't know that it was fun for anyone. It was really stressful. So
It was, and I will tell you, we're really excited about this. Everyone's always looking for tax losses at the, places for tax shelters at the end of the year. When we launched this a couple of weeks ago, to other fund managers, I think we're already sitting at 106 or 112, million in soft commits already. So I'm very excited about that. I'm really honored to have partners like you come in and, participate in this fund.
yeah,
We had
too.
a question come in that we might as well cover here, which is if if an investor invests in this fund now, when can they get the tax benefit?
Yep,
2025 or 2026?
2025. It will be for this year.
Okay,
Yeah.
great, thanks.
A couple of more that I see here is there a way to project overall return on a 100K investment? That's kind of what we're doing here with the 2 to 3.5x estimated return of capital in roughly 2 to 3 years. Again, my personal experience. My first investment 2 years ago with Courtney at the end of 2023, invested in 2024, got a 40% return. And that's as prices were coming down even.
Yeah, they did. And so we are estimating about that 2.5 year time frame, for where we're at now. Now, obviously, if prices go up, that can go down and it can fluctuate a little bit. So just know we've done a really good job of estimates, but they're all estimates.
Yeah. And the other thing to keep in mind is you'll start out really high, but that will decrease over time. But again, the goal here, the big thing to keep in mind is you're going to get your money back conservatively in 2 to 3 years. And at that point, it's like you've funded 2 investments. You've made your oil and gas investment, gotten a lot of money back just in year one. And for me personally, I did a 30% return conservatively on tax savings, 40% in the monthly passive income. So in 2024, I made a 70% return. Now I can go take that 70%, put it into the next oil and gas deal, put it into real estate deal, whatever it is, stocks, while this oil and gas deal continues to pay me for the next 5, 10, 15 years. And let's see, distributions. So we're going to raise capital here for the next 2 months. We'll talk about next steps here in a bit. Distributions are monthly, estimated starting January 2026. And one of the questions that came in, how long do you expect the fund to be fully invested? We're going to be deploying capital as it comes in. Our goal is to complete all of our acquisitions this year, so that we can take the tax deductions. Go ahead.
Yep. And we get, this is a big question that I always get is, can you deploy that kind of capital? Do you have really good deal flow? And the answer to that is yes. I mean, we have anywhere from 30 to 50 deals come across our desk every week. I'm actually looking at another energy fund that I like. It's an institutional oil and gas fund that has a lot of the people that run Exxon and Chevron and RBC, Dane Rauscher are a part of it. So I like that deal. And then we've got several deals with Coda up in the Bakken. We've got a whole bunch of stuff with Mewbourne. Mewbourne is another really big they kind of trade places with Continental as the #1 private producer in the country. So we've already got a whole bunch of stuff that we're looking at. We acquired some other things throughout the summer, and we will allocate it and buy stuff as it comes in. And we will close this out this year because we want to keep the tax benefits clean. Everybody comes in, they get the tax benefits, and then we'll start distributions early next year. I think it will be January. It could possibly be February, but it will be early 2026. Our first set of wells, they've already started drilling, and they're really quick about paying out. So
Okay, and the use of funds here we've listed here below, 10% to management, syndication, legal fees. That 10% is one time upfront for everything, that we're doing to put the deal together. Go ahead, Courtney.
well, I was just going to say, I always get questions like that's a lot. It's different than what you see in real estate. And this is actually very standard. Actually, we have lower fees than pretty much just about any other oil and gas companies out there because they charge that up front and then they charge, 2 to 4 or 5%, annually every year. And we do not do that. And the reason we take it up front instead of doing it throughout the year is it actually gets passed on to the investors as depreciation. And so there's tax benefits wrapped in there. So there's a lot of strategy that went into building that out.
Yeah, and in the hedge fund world and real estate syndications, like you mentioned, it's typically 2% a year. This deal could go for anywhere between 5 to 10 years, right? Estimated
Yeah,
7.
yeah, and the goal is to exit around 7 years. Now, if we are sitting in a time frame and let's say we either haven't depleted, 85% of the oil, or maybe we're sitting in $65 oil, we don't want to exit in a lower market period. We want to exit when oil and gas prices are really strong and we're getting really big offers for our deal. And fortunately, Rick's brother is part of a family office, and we have other, several family offices in our pocket that like to purchase these assets. So we'll dispose of them, but it could be at year 6 and it could be at year 9. We want to make sure, like I said, that we have depleted the oil that we need to deplete to make sure that we don't have any kind of a recapture situation. And then we also want to make sure that the market conditions are the best that they're going to be so that we can exit. And like Keshav said earlier, that contingency money, any money that we have pulled in to allocate to drilling costs and other things, we will put that in a money market, interest-bearing account, and anything that does not get utilized will come back to the investors with interest, when we decide to exit the fund.
Yeah. And the other thing I'll mention is that 10% management fee up front, that is a part of the deductions that investors will be claiming. That goes into that 80% deduction
Yeah.
they're taking in year 1. But besides that, 10% of the funds will be used towards leasehold acquisition costs, and the remaining 80% is for drilling, testing, and the contingency. So our rough timeline here, the fund is open from August 25th to November 25th. We spent last month just getting everything in place. Now everything should be in place. Asset acquisition, we've already started. Now Courtney's found us 8 great wells, and we're going to be continuing to acquire through the end of the year, more or less. And they should start producing here in the next month or so. It's obviously we don't that brings me to the asterisk down there. We have no control over when distributions start from the operator, but once they do, it's monthly. So there's no exact date to when these companies start drilling, but again, we typically acquire once they have. And then 2 is distributions roughly should start at the end of January, but again, we have no control over that, and there is some waiting time there. It's been
Yeah,
as
and
low.
part of that will also depend on, we're looking at some Coda wells up in the Bakken. They're already permitted. They're about to start drilling. So it really also is going to kind of be determined by, where are they at in that drilling process. We do like to acquire them once they've already actually broke ground or spud and started drilling.
Yeah. But that is one thing that I will clarify. It could be as soon as 3 months, and it could take 6, 7 months. So there is a wait period there, but because we're diversifying across multiple companies, one of them should start paying rather quickly. So our asset underwriting criteria. So we typically work with operators who have 1,000+ wells under their belt. If you just started an oil company yesterday, sorry, but we're probably not going to invest with you. Second, top producing proven areas, the basins that I mentioned earlier, $40 max break-even oil price to weather low prices, right? Like we're going through right now, 80 to 90% K1 tax loss. and a $500 to $800,000 average estimated unit recovery per well. So just saying that, hey, each well will roughly produce between 500,000 to 800,000 barrels of oil over the lifetime of whenever it produces. And at most, to mitigate our, not putting all of our eggs in one well, 10% max ownership in any single well. And any potential asset will be underwritten and presented to the advisory board to be voted on.
Yeah, and I want to pop in here really quickly because I do get asked, why a 10% max ownership in the well? And there is a question in the Q&A that asks about the level of liability, and that question kind of plays into this max ownership. So, I like to kind of hang out in that 2.5% to 5%. Some of the wells that we've bought, we do have a little bit more than 10%. But when you really start breaking down that liability, and yes, you do have to come in with unlimited liability. The first thing I do want to point out is that we always opt into the operator's insurance. So whether it's EOG or Continental, they maintain massive amounts of insurance for any kind of liability or accident that could potentially happen at these well sites. And we do opt into their policies when we purchase these interests. Now, what I do want to break down is let's say that we have a 5% interest in a well, and I like the 10% or lower because not only does it play into how much we have to pay for any cost, but also into that liability. So let's say that something terrible happens and there's a lawsuit and there's a $10 million award up and above and beyond the insurance policy. If we have a 5% interest in a well on $10 million, the entire $100 million fund's liability in that is $500,000. And when you break that down, I can actually tell you what that number breaks down to and what that translates to, but it's not nearly as significant as what that would end up being $500 a person. So we do have contingency funds that would be able to cover that. But let's say we don't have a contingency fund and we had to pass that on, it would be $500 per $100,000 investment. So a $10 million award sounds really scary, but we have got this asset underwriting criteria. There are very specific things in here for very specific reasons. And that 10% max ownership is one of the reasons. It plays into the liability and also any additional costs that may come up. It kind of keeps us protected in that area as well.
And here on this opportunity, investors will be a general partner for 2025 and 2026. Just to ensure that we get the tax write-offs, because these drilling companies have until March of 2026 to deploy their capital, and we have to stay on as GPs until they deploy that capital.
Yep. And so then once all of the drilling costs have actually been deployed and paid out to the oil and gas companies, we will convert you on January 1st the following year. And just to even, the liability is always a huge concern. And I've been a part of oil and gas working interest my whole life. I have never had to go to court. I've never been dragged into anything. I'm going to knock on wood. I'm not saying that can't happen, but your biggest part of the liability is usually through the drilling process. Once you get done with that, there's really not a whole lot going on out there. You've got pump jacks on these wells. You've got well servicing companies that are out there servicing. And typically, if there's something that they do, it's usually going to be on some of these other companies and not on us. And so I want to ease your mind in that a little bit, that it sounds really, really scary to say we're taking on unlimited liability, but it's when you really start breaking down the insurance and the max ownership and what those numbers, actually come down to, it's not nearly as scary as it sounds.
Yeah. And the other thing also is starting 2027, you will be a limited partner. So your
Correct.
risky, quote unquote, risky time period, even though we mentioned how all the ways it's really not that risky, is a year and a quarter, roughly. After that, you're a limited partner, your liability goes away.
I think we can answer this question, which is it recommended or advisable to invest in an oil and gas fund through an LLC?
So that's a really great question, and it really depends on where you want the tax benefits to flow. So if it's a single member LLC and you're wanting them for yourself, then you can invest through that LLC and you'll be able to take them personally. But usually, if it's a multi-member, you're going to need to invest directly as yourself. And so I have people that do come in as trusts. So it really just depends on where you want those benefits to flow, because however you invest is where those tax benefits are going to go.
And we always obviously recommend consulting your, legal advisors on how to structure these things. But it is possible to invest, individually, move it to a trust, vice versa. That is something that we can help out with. Another question that came in, I heard people say the profit gets less and less after 2 to 3 years. That's because it's a depleting resource, right? So in year one, is typically where you're going to get most of your production, most of your returns. And then there's only a finite amount of oil and gas in each well. So as years go on, you're going to extract less and less.
Yeah, and most of these wells are going to produce, probably around 30% in year one, and then it goes down from there. Every area has a different depletion rate. And so, some of them, they're going to produce 40 in year one, and some of them are going to be 20. But this is once again, we've taken the averages and said, okay, this is typically what we see. Here's the averages. So not only have we taken the average oil price, but we've taken averages for what we typically see for production in year one. And then also, we were pretty conservative on that estimated ultimate recovery, which is how much oil we expect each of these wells to produce. When we underwrote these Colorado wells that you're looking at on this slide, those are expected to produce anywhere from 650,000 barrels. And we've got two wells in the previous deal and the one before it that have EURs of, 1.3 million barrels. So we underwrote this that, every one of them is going to produce 675. So it's very conservative. I feel very good about that. And then we underwrote it at the lower prices. So all of those things have come into play, and hopefully that's not causing any confusion.
Yeah. Another quick question here. Do we send periodic reports? Are we able to see financials in the reports? So we typically send out monthly reports with production data and financials, expenses, revenues, things like that.
Yes, and we are going to have an audited financial. We do send out our monthly reports. We like to share, what the operating costs were, what the income was, and typically I like to provide, you can actually go into any of these public sites, any state that has, oil and gas production. There is a public site that's federally regulated, and you can take the API number for a well, which is kind of like the serial number or the name, and take a look at, what the actual production is that's being reported to the government. And so whenever we get payments that come in, we double check with those institutions to make sure that what we're getting paid on is actually what's being reported federally. And because of who we're participating with, EOG, Continental, these are very, very, a lot of them are publicly traded. They're very reputable, and we try to avoid companies that are known for gouging people on, lease operating expenses and things like that. So, and because we've been doing this for a long time, and Rick's been doing this for a long time, he's got great relationships with a lot of the landmen in many of these companies. So,
Yeah. Another quick question. If I invest through a self-directed IRA, would I still be able to take advantage of the IDC deductions? And that is a no, because it's a tax.
So you'll be able to take advantage of them, but you will only be able to utilize them against passive income. So we did have a couple of people that came in for the first time with a self-directed IRA into the Bakken 5 deal. And because if you invest from a tax sheltered vehicle, you cannot offset active income from that. So so that you will get the tax benefits, but it will only offset passive income.
Okay, good to know. Okay, we'll continue here. We do have the data room that we're going to be sending out to folks who soft commit. We'll have answers to all these frequently asked questions and more. So this is the first asset here in the fund, 8 wells with Fulcrum in Colorado, I believe. And they've already been spud. Completions are scheduled for November. And we bought it for $9.5 million.
Yeah, it's a 9.5 million. We bought it for 935, and then it's about an 8.6 million allocation for all of the drilling costs. So
Okay. The executive summary there is that they're going to drill 8 wells in Jackson County, Colorado, and everything else. It's 8.5% working interest, 2 to 2.5 year return of capital at $72 oil. All 8 wells have already been spud, meaning drilling has begun, and production is expected to begin this month or next month.
yeah, and they changed directions on 2 of the wells, and so they have actually pushed the production time frame back to November. So they've spud them all. They started spudding, but they are not expecting them. We got an email not long ago that said they expect to have them online and producing by November. So apologize for that.
No, I mean, that's part of investing, right? You can never know what these companies are going to do or think. We can just take our best guess at what they're going to do. And we do our best to mitigate it. But again, this is just the first 8 wells out of 50 to 100 that we'll be adding to this $100 million diversified fund. And this is the offset production. This is basically what we use to determine how much we expect our wells to produce. It's the oil and gas equivalent of running comps in real estate. You look around and you kind of say, hey, how much did the wells around me produce? Let's, I don't know, take an average or be conservative. And that's what our estimated ultimate recovery EUR is going to be. So the investment process is filling out the soft commitment form, which I linked below here. So if you go to clivecapital.com/iron-horse-energy-fund-I, mouthful. There's a soft commitment form there. Let me pull it up here on my other screen and move some stuff around. I can show you guys what that looks like. So if you go to our website here, clivecap.com/ironhorseenergy-fund-1, you'll see some of the high-level details that we covered. And then you can go down and there's a ready to soft commit button, and you just click submit your soft commitment. It'll take you to a Google form. In addition to that, once you fill out that soft commitment form, again, it is non-binding. We're not going to hold you to any commitment. You can always change your mind, but that's just to let us know that, hey, you have an interest. That's it. We won't hold you to it. Once you do that, we'll send you access to the data room, the marketing materials, including this pitch deck, a link to the webinar recording, the FAQs that we have compiled, sample Schedule K1 tax forms, and more. Next step is to obtain your accreditation letter from Parallel Markets. It's free, takes less than 24 hours. You just go here, parallelmarkets.com/get-accredited, get your accreditation letter. If you've invested with us before, you should be fine, but just double check with us. Sign the legal documents, which we will send you access to all of that, show you how to do it. Happy to walk through the process with you on the call. Fund your investment, and then sit back and enjoy tax benefits and passive income. And we will keep you informed of the progress along the way through monthly updates. And the monthly updates, that's a part of our white glove service. And so what you can expect is monthly drilling or partnership progress reports. You're not going to be left in the dark. You will know what's going on with your investment. Monthly cash distributions. Again, I will stress we have no control over when they start, but when they do start, typically in 3 to 6 months, it's monthly. Annual tax documents, Schedule K1 tax form distributed mid-March, and regular communication on production and payment progress. So with that, thank you for joining the Iron Horse Energy Fund 1. Here again is the link to submit your soft commitment, clivecap.com/iron-horse-energy-fund-I. And with that, here are our cell phone numbers, emails, calendars to schedule a call. We're available for any questions that you have. Book a call, text us, email us, whatever it is. And we're happy to answer your questions and hopefully have you join us on this amazing opportunity.